All right, everybody, it is 8 o'clock, and that means it's webinar time. I'm going to go ahead and get this thing rolling. I do have quite a few slides to get through tonight, so I'd rather get done a little fast and have some question time if possible. But with 40 slides, I doubt I'm going to average 2 minutes a slide, so we'll see how we do and how we get along on this thing. But I got lots of good stuff for you all. Mostly, as I spoke before, this webinar is going to be an augmentation to the prior, part 3. This one I titled the Camarilla System because it's much more in depth as far as the read and the look. And we'll go through a few different things, maybe still blow a few minds. We'll see what happens. So to get started, let's get rocking and rolling. First, before I can get into the fun stuff, got to start with the legalese here. We got a little disclaimer up here, just reminding everybody that, we're teaching off of our personal experience and trying to teach you what works for us. This in no mean knows we will know what works for you. So we're putting out good content for you all. Hopefully there's something in here that gravitates for you and really ends up being something that changes and helps out your trading. Just a quick look at the table of contents. This is really what I'm going to be trying to get through this evening. So we will make it a go and see what happens. So before we get going, just want to introduce myself to anyone who is new to the room. Maybe your first webinar and your first time in here. Maybe you haven't met me. Hello, welcome. My name is Thor Young, and I'm a moderator proudly with Bear Bull Traders. I have been trading for around 4 years, and I've been consistently profitable for 3 of them. Other than my beautiful family, my obsession falls to trying to understand what makes the market tick. And as I push forward, it's been my goal to take the complexities of the market and dilute them down to a more tangible view. Before I introduce the concept, I want to take a moment to highlight a very specific topic, and that topic is overreaction. Because we are in this new digital age of stock trading, it's often easy to forget that it's made up of people. Although there are algos out there, we don't really have any evidence of some massive program or system that is in place to help the ultra in-the-know traders. In reality, we are all facing the same adversary, ourselves. And as people, we too often let our emotions make choices for us. After all, what is value but a perception of what something is worth? Perception is an opinion, and opinions are emotionally driven. This reality causes the ebb and the flow that we see in the market. As participants make decisions, the market moves. And since we tend to overreact to just about everything, this makes the market volatile and almost ensures price action will never be stagnant for too long. With the acceptance of value comes stability, but it's only a matter of time till that perception changes. Then rejection and imbalance come into play. The following addition to the Pivot webinar is an augment to the system. After my last presentation, as I mentioned, I had a lot of requests to cover the full system in more detail, and in this webinar, we're going to focus on avoiding the chop by trading the extremes. We will detail out more precisely how to use the Pivot cheat sheet to identify potential trading criteria and manage trades. I hope everyone enjoys this addition to the series on how to day trade using Camarilla pivots. In the past few webinars, we have been looking at the various aspects of trading, not just pivots, but how to trade the market in general, how the theory behind the market works. We've learned how to read the market and how to apply that to a where, when, and how kind of strategy. In this webinar, we're going to be taking things to the next level. Prior to this, we have learned the concepts and the terminology. Now we put it into the system. A system is more than a strategy. A strategy helps you decide how to take a single trade. A system helps you plan, take, and manage your trading day. In this webinar, we're going to work on how to avoid choppy price action using a pivot-based trading system. But not only choppy action, but any price action. I've been evolving this pivot system over the last half a year based on some of the most popular pivot trading strategies available. With it, we can more accurately gauge breakout days versus days we will likely be range-bound. Soon, we will take a deeper dive into that pivot cheat sheet, and using the flowchart, we can categorize stocks in play by range type. This allows us to form a bias and target the ideal locations to take trades. With our ideal trade locations selected, We won't get stuck in choppy price action. Rather, we will be waiting for signals at our targets to take and exit trades. To get going, let's start by looking at a common concept in a whole new way, and that is how we perceive value. What exactly is value as it pertains to the market? The easiest answer is when a transaction occurs, value is established. But that value doesn't last long. As soon as another transaction occurs, value changes. Value itself is in fact nothing but perception. What does someone think something is worth, and what are they willing to buy or sell it for? Do they think it's worth more, so they will keep it? Or do they think it's worth less, so they will sell it? A stock is viewed in this way by the market's participants. Is it under or over value? The perception of that by the market's participants will have a massive impact on which direction the stock price moves. The stock market gives us something unique with our modern technology. Not only can we see where value is tick by tick, but we can chart where those ticks congregate. Each tick at a specific price adds up, and over time, these individual transactions will gather, starting to reveal where value is being perceived by the larger market. As larger participants buy and sell, value is influenced and often set. As we know from auction theory, the highs and lows of each day are defined by these participants. As there are more participants, it becomes easier to find value. As we watch the participants enter and exit the market, we can begin to make choices. This leads us back to the principal theory that drives the CM.Pvt system. That theory is that because the market is made up of participants, and that the participants are people or systems programmed by people, that the market will inherently overreact to value. You see, people by design overreact to almost everything. It's a psychological reality. Have you ever noticed that certain stocks seem to have a personality? You can trade them over and over again, and it seems like they always behave in a similar way. That is because the psychology of the participants carry over to the stock. As we've talked about in prior webinars, the idea here isn't fancy. We have no idea of which way the price is going to go until we can figure out where the broader market is establishing value. Anything else is just gambling. There are some good strategies out there to take advantage of the quick auction periods, but those often get you stuck in choppy price action as larger participants make decisions. But auction periods are very volatile and can be very difficult to manage risk. Waiting for value to be accepted and then rejected gives you the ability to sit back and plan very detailed and conditionally based trades with great RVR. As the market tries to establish value, the largest participants will have the biggest impact. As they set value, other participants will make decisions based on that price action. This causes the ebb and flow that the CM.Pvts attempt to quantify. As people overreact to value when larger participants make decisions, the price will constantly accept and reject that perception of value. So let's talk about accepting and rejecting value. Since value is based on perception, it can be very difficult to find. We have covered before many technical ways to find value, VPOC, levels, level 2, etc. Once value is set, it needs to be accepted by the market. Value is accepted over time. You can see large participants with big orders trying to set value, but until everyone else agrees this is the spot, nothing is written in stone. Often you'll see the market rally after large orders on low volume. This is because the retail traders haven't accepted the new value and continue trying to push the price. Eventually, the price returns and we establish value. The L2 will often lack large bids and asks away from the price when we've found value, and the volume will often drop down. In reference, most consolidations happen in or around value. So just looking right here at the chart here, just want to show you, this is a trade from Roblox, or a chart from Roblox the other day, and I just want you to see how you have this large volume spike. If you can see my little arrow down here, around 1020. this was coming into large sellers on the level 2, and that actually set value for the rest of the day. And you can see how VPOC lined here, right? And basically what we ended up doing after that is we tried to move away from it, but we pulled right back to it. We tried to move away, we got pulled right back in. We tried to reject down, and we got pulled right back up. So you can see the broader market really started to accept Roblox as value. And it wasn't until later that we actually broke out and rejected in the top side and started trying to move away from value. Again, being another attempt to move away. But we'll see plenty of examples of this throughout the this webinar. But the reality is this is what happens all day, every day on almost every stock. Not almost every stock, on every stock. We're going to run until we hit a value area. Large participants are going to come in. They're going to set value there, and then the stock is going to ebb, flow, chop all around until value gets accepted, and then we're going to reject in one way or the other, right? Now, once value is accepted, you will often see a consolidation and then a trend continuation or a reversal on light volume. This is an attempt to reject value. Let me clarify that rejection of value does not mean up or down. It means to move away. Once we have value accepted, we will see the price attempt rejection in both directions, under and over the price. It will continue to do that over and over again until it doesn't. After all, that is what the Camarilla system is based on. Eventually, momentum will build in a particular direction depending on the supply and demand. As imbalance starts to set in, the perception of value in the participants will start to change. Eventually, the price will reject in an attempt to either return to prior value or go in search of new value. This rejection is where our trades begin. It is very important to wait for the large participants to make decisions. I'll show you a trade shortly on DKNG I took recently where that was very true. So let's take a look at an example of value being accepted again, and then I'll talk a little bit about what I call the gray area. So first, here is the DKNG trade I was talking about. So you can see here that we had accepted value here, right? But one thing we didn't notice, I noticed on the level 2 actually after I got short, was that there was still an order at $49, and a big one, really big order up at $49, right? So what happened was as the price pushed up here, I went short as it tried this breakout and rejected. I went short and immediately got met with a good downside volume. I felt pretty good about it. But you can see here we eventually curled up and I went out at break even, and the stock went on a run up to that large seller. Right, just a perfectly good reason of why to pay attention to the L2 and wait for the large volume, right, spike to let you know that you're done and that you've exhausted the sellers. So sure enough, we went through 49. There were no large sellers left above, and the bid started to stack up heavy to the downside. So I went ahead and went short, gave myself high of day just to be safe, and got a 3+, almost 4R move on my first partial. And then a couple more partials down at this daily level because we were going to be closing soon. So I was going to hold out all the way for the drop down to VWAP and would have just about got that. But you can see that this was not a bad trade. I'm perfectly happy with this trade, but it's just a perfect example of showing how the price is going to go in search of new value. And then once it hits, it's going to return. Right? So we have this move up, we attempt to break out and go up, but eventually we can't set value up here, so we hit this large seller and then we come right back down, right? So another really good example of value being set. Cruise lines have been in Catalyst the past couple of days. Norwegian Cruise Lines especially has started listing sale dates on their website. They're selling tickets again. Alaska, I believe, Hawaii, and the islands have all reopened their ports or are starting to reopen their ports in some instances. And this has caused a rotation back into travel, at least a small one. And what I've noticed here is the cruise lines have been moving up pretty bullish from day to day. And you can see NCLH, and this is, I'll show you the larger view on this, but you can see how NCLH rallies up, and look at the large spikes here. right? These are large participants setting order right here, and this sets value. And we spend the whole rest of the day, right, hitting value, rejecting it, coming back up to it, rejecting it, and coming right back up to it, rejecting, coming right back to it, and then trying to reject away. Over and over and over again. This is what can get really, really difficult trading-wise, right? Because you have value up here, and if it pulls, and if you're trying to go long, right, up here, you're going to find yourself having a lot of trouble because you're just at this high extreme. You've got tons of orders. You've got large selling. Your best opportunities are going to be the downside. But because we've set value here, right, there really ends up not being a trade at all. The one thing to really pay attention to characteristically is this. Notice the volume, right? After we're done with these big orders and we start to sell off, you could go short here. You'd have probably gotten a little move down partial, then you came back to the average, and you would have noticed that you've dropped into like no volume whatsoever. It's a big, big clue that you're in a consolidation phase now. And if you found value and you're starting to consolidate, there's no trade anymore. Right? You don't even need to look at this stock. You can right click it, delete it, right? This thing is done. So same stock on the larger time frame, right? You can see our move up to value and see how we set value here and basically closed out the rest of the day at it. Right? But again, look at that characteristic, that just insanely low volume after the fact as we just kind of consolidated around there. Right, when you see the elevated volume, these are your transition periods. These are when you have your chance to do something. Right, so I actually traded in CLH on this one, and I believe I traded an R4 breakout on it. That worked pretty well. So let's talk about the gray area. One of the many things we are going to cover, and we're going to do it now, is the gray area. In the Camarilla strategies, we like to wait for the stock to establish value and then reject it. As that rejection happens, the goal is to play the extremes of the price action. So we want to wait for the price to rally and then short it for a long trip back down. Or let it sell off, accumulate, and then play it long for a ride back up. This gives us the best possible RVR. The gray area is where you're most likely going to get chopped. Since you're playing close to value, you will often find yourself taking lots of stops as you wait for the stock to pick a direction. This is why we want the extremes. To avoid the chop, if you keep trying to play value, it's like tossing a coin at best. But in reality, it's worse. Because when we are at value, we expect the price to move up and down as it builds momentum. We will use our Camarilla pivot points to help dial in the gray area, but the gray area is also a time frame. Any trades done into the pre-market or in the first 5 minutes or so, gray area. Since we haven't established value, there's no way to tell if it's being accepted or rejected. So in that regard, we're attempting to gamble at what we think value will be, rather than waiting to see what the value is. On the next slide, I'm going to show you a quick look at the gray area, give you an idea of that. So another little look at NCLH. And my apologies on this one. I have a large monitor, so my pointer comes off a little small. Not much I can do about that. But what you can see here is that we're stuck in this range here, right? And notice S1 through R2 are gray, right? And that's because that's what I consider the gray area. Any trade in the S1 to R1 levels is going to just be incredibly difficult to pull off, right? Because you're going to be trading right out of the center of the range. So at best, you're hoping to get to the bottom of the range, and if you're going long at best, you're hoping to get to the top. But either way, you're starting off in the middle. So your RVR it's just not great. So rather than do that, the better way is to play this one, and would be a little early, but play either the Rising Devil as it went through R3. That's a momentum play, so that doesn't really fit in with our strategy, but it does wick R3 and loses it. But what I like even better is notice this third retest of R2, right? We pull back to a third time. We stall here, make a new low. Short here at VWAP, given the loss here, we at least are under R3 and we can play to the bottom of the range and at least get some good RVR. But either way, we can stay out of the chop. And honestly, on a trade that looks like this, you may just want to consider not trading it at all. When you get something that has a range that's like this, right, where your gray area and everything is so stacked, you're really only going to want to trade from the top of the range to the bottom and vice versa. So anything in here, again, you can avoid the chop if you just kind of stay out of it. So I've covered this before, but I thought I'd throw it in there just so it was in this presentation. So if you didn't get it, you didn't have to go back and reference the prior one. But I included the steps for setting up the Camarilla points in your DOS. All you got to do is right-click on your chart, go to Study Config. You're going to add in the pivot point study, and this is how to configure them down here. Just a reminder, make sure to uncheck everything in the general config. You get that by going to config X. It'll keep your charts from looking all squashy. I just want to point out too, down here, notice how my S1, S2, my R1 and R2 are actually coded gray just to reinforce that whole gray area concept, right? So I just pulled this one over from the other one. These are my old Tron dark charts. Aren't they fun? But you can see here that our green levels are going to be the levels we're going to be using for traverses and breakouts, right? So that's why they're colored green. And our red levels are the opposite of that, right? We're looking for traverses and bottoms, right? Extreme reversals off of these red levels. So let's talk about the kind of day we hope to have on these things. A major part of the pivot system is reading the relationships between pivot ranges to determine if you are more likely to have an inside day versus an outside day. An inside day is represented by a wide pivot range. In most instances, the prior day's pivot ranges will be narrower, and you've most likely recently had a breakout or a major move into this range. An inside day means exactly what you would think. Since the ranges are so wide, we are not expecting a breakout. Rather, we are expecting traverses inside the range from the top to the bottom and vice versa. This is one of the best things you can do to help avoid the chop. By deciding what kind of range you're expecting, you can plan your trades accordingly with a solid bias. If the price is opening near the top of the range and it looks like it's going to be an inside day, then you won't be looking for longs. You will wait for the price to squeeze to the top of the range, and this will allow you to trade it short and get maximum potential out of it, since you will have the entire prior range beneath you. Naturally, just a reminder, please make sure to wait for clear volume signals before entering. As mentioned before, the other type of day is an outside day. An outside day, or a breakout day, often has more chop in the beginning of the session, but eventually makes a breakout in search of new value area, either higher or lower. Remember, we play the extremes, and R4 is the extreme. As the momentum builds and we break out from the fourth levels on a narrow pivot range, we can expect a large move out of range. Outside days can be very difficult for momentum traders because most momentum traders like to get in early, tripping over dollars to get dimes. On a day with a tight pivot range, it will help to wait and let the price bounce around inside the range for a while. Sometimes 5 minutes, other times an hour or two, while value is established. Once the price breaks out from R4, you can expect a long run up to the next value area. Once you are on an R4 break, you should expect to continue on trend until a large order halts the movement and attempts to set value. On breakouts, I often like to take a little profit and then set a trailing order to take advantage of the move, only getting all out once we lose the trending averages. These days can be some of the most rewarding and large movers, can be very expected. So I want to give a little bit of a breakdown here on the pivot ranges on the SPY. You can see up here, we've got value that has been accepted, right, across the broader time frame here across these 2 days. Right? You notice here we have this tighter pivot relationship here. So we end up actually opening above R3 and we break out from R4, and that's where we set value. And we actually set value hard right at the end of the day. Just before 4 o'clock, we have a really large transaction that happens right at 4:15-ish. And that really sets value for the next couple of days. On the next day, notice SPY has a much wider relationship, right? Now, this is really important because although we are up, which gives us kind of a bullish feel, we are opening really high on an already wide relationship, right? So our thought here should be an inside day versus the prior day was an outside day. So instead of planning to take this one long, I'm actually going to look for this to squeeze and short it in R3, which would have been a viable move down. And you can see we got a drop from R3 all the way down to S2, which was not a bad move. But notice what our objective really was. Here's value. We attempted to reject it to the top side. We ran out of momentum, so we returned right back. Right? We never got away from value. And that is what happens over and over again in the market. We attempt to reject and we fail. We attempt to reject and then we succeed. Right? So notice on the next day, we have an incredibly tight pivot range, especially compared to the prior 2 days. So a breakout here is very likely. And not only that, we actually find ourselves opening at R4. This is primo breakout territory for us. To be in an inside range, breaking out above R4 is everything we really need as long as the price holds and moves. You can see at the open, we sold down a little bit into VWAP and then ended up making a break and ended up doing an all-day run up to 420, right? Never came back inside the cams at all to retest. Notice also that this 120 area happens to be right around R4, 420 I mean, happens to be right around R4 on the prior session, right? Still holding true even the next day. I like going back for a couple of days. This, Terry, works on any time frame. So it can work on your long term, it can work on your intraday, anything in between. Volume, price, and relationships all tend to hold from day to day. So we're going to go along with the cheat sheet, and I'm going to talk a little bit about forming a bullish bias. The most notable way to determine this is the pivot relationship. If the pivots are above the pivots from the prior session, we are already going to have a more bullish concept overall. This doesn't mean it's time to go long. It just means in the overall trend, the stock's price seems to be on the rise from day to day. Before we can confirm our bias, we need to see where the price opens. If the stock is in play, this is a great time to form some contingency ideas. For instance, if the stock price opens near R4, I'm going to let it sell off for a bit. If it reclaims R4, I will go long. However, if it opens under R4 and struggles, I will look for a short for a trip back down to the most established area of value. Remember, we are playing pivots, basically a decision point. We either go up or down, but we're going somewhere, and a choice needs to be made. If we continue up from the R4 breakout, then we can estimate we are going in search of new value. As long as the volume stays consistent and we don't hit any large sellers, it's likely we will continue to run. But if the stock loses momentum, we'll come right back down. Our bearish bias is formed in the same way, only in reverse. Since our ranges are going to open lower, we are seeing a trend down on the larger time frame. Again, this doesn't mean we are short off the go. Quite the opposite. We need confirmation. The only way we get that is to wait for the stock price to open and see where value sets. But for now, we can have an overall bearish bias on the trend. The reason we need the price to open is the overall trend gives us very little information. Sure, we've moved down yesterday, But what if we are near the bottom of a significant range? This is why we need to factor in other variables, like significant levels in value across the broader time frame. We can't play the rejection of value if we don't know where it is. The CAM points will give us some ideas of ranges and where the price can go, but it's up to us to decide which direction the price will pivot and how to trade it. In many instances, you will have a strong upward move on a bearish trend. This doesn't mean you don't trade it. It just means you need to have the proper expectation for the trade. Since you are overall in a bearish trend, it's likely you're going to run into resistance faster. So traverses will often be a great tool to play the bottom of the range back up to value. We will cover those strategies shortly. When today's pivots are closed in by yesterday's pivots, we are unable to form a bias on the overall trend. This is not much of an issue because many of the major breakouts can happen from tight pivot ranges like this. Because of the tighter range, think of the SPY trade I showed you earlier, we most likely have compression occurring on a larger time frame. This means the stock is near the breaking point that will cause it to move in one direction or another. If the stock has a viable catalyst, these tight pivots combined with an outside day can produce some very explosive moves in one direction or another. Next, we will talk about confirming our bias with the open price. Where the price opens is critical. If the price opens too high in the range and doesn't have the correct momentum, then you can expect a return to value within the pivots. Breakouts take a lot of effort on the part of the market, so the signals are often quite clear. Sometimes the lack of volume can be all the information you need to take a short as the stock breaks trend in the opposite direction. So, step 2 in our pivot sheet is confirming the bias. And basically, this just kind of, I added in some additional criteria. So I'm going to have an updated cheat sheet coming out that has these values in it. But basically where the price opens, as I said before, is critical on how we play the stock. Even stocks on a bullish trend top out at some point, and the last thing we want to do is go long at the top of a trend just to have it fail and return back down. Not paying attention to this will often result in getting trapped in the dreaded chop fest. If the price opens above or below the pivots, we are looking for a breakout or extreme reversal depending on the VPA. If they open within the price, then we are looking out for traverses back through the range and breakouts if we have the setup for an outside day. So just coming back to confirming the bias, so you can see here, and you'll see this on the whole flow, but if the prior session, right, closed above its pivot range, and today the price is opening above the pivots, this is the setup we're looking for an R4 breakout right off the bat. If that holds and it holds value and makes new highs, you're pretty much good to go. Right? If the price opens slightly under R4, right, then you could actually be looking for a trend reversal back down. So on a bearish one, it's very, very similar, right? If it opens lower, the price closed lower, and you're looking to open below S4, then you're really, really bearish, and you're looking for an instant dump, basically, right off the bat. But in either instance, and I will re-upload it. I have it in the room drive, but I'll upload a fresh copy of that to everybody. Now, to augment that, if we have our price and our price opens inside the cams, then we're going to have some different decisions to make, right? If it opens under R4, we need to wait for the stock to sell off and bounce out of the gray area. So you still can go long at R4 or play the rejection of S3 in this scenario. Or R3, but you got to wait for the price to move in and out of the gray area before you can trade it. That way you make sure you're still getting the good RVR. The big reason for staying out of the gray area is the RVR. Once you're trading inside the gray area, it gets really, really hard to hit those real solid 3 and 4 to 1s because you're just in the middle of the range near value. You need to let it get away from value so that you can play the return and hopefully the rejection to the other side as we ebb and flow through value, right? So same thing on the downside. Prior session closed inside the ranges. We're opening lower, but we find ourselves at the bottom of the range. In this instance, we may be looking for a rejection, right? And we're going to be going long at S3 for a breakout to the potentially to the top side if we end up on a narrow range, right? Or an outside day. So we've talked about inside or outside day, so I'll cover it one more time. This is how this works in the cheat sheet as well. A narrow CPR has, or a central pivot range has two views, right? Which is basically chop and breakout. So when you're narrow like this, you need to wait. Remember, these are the days that I talk about are going to be the big traps for the momentum traders, because you're going to want to get in a position early and you're just going to be bouncing around like a pinball inside of the pivots, right? So what you need to do is you actually need to allow it to come outside of the range, outside of the pivot, and play the breakout or play the reverse. So if we have the potential for an outsider day or not is the most important thing to decide in this system, if not one of them. Either way, we're going to have an opportunity to make money, but you don't want to be trying to go long near R4 when the stock has a wide pivot range. The reality is you're already extended and the probability lies much greater to the downside at that point. In an outside day, you have an extremely narrow pivot range. This tight look will result in a lot of chop. So you must avoid the gray area like I mentioned entirely. Wait for the extremes to be rejected and play either breakouts or extreme reversals off the fourth levels. On an inside day, you have an extremely wide pivot range. This range will often result in lots of chop near the extremes, but in this type of range, you will play the traverses from the third levels. Since the range is wide, there will be plenty of space here for you to get profit. Just make sure to be patient because these trades can take some time to move since they're just moving up and down off of previously established value zones. So, a little example here on Facebook. Another instance of where you can see we're moving up to value and then accepting value and we stay there. Notice how we have a wide pivot range here on Facebook. And then notice the next day we end up with a significantly narrower pivot range, right? We're very, very tight. Now we're opening a little bit to the downside, so it kind of has a bearish feel overall. But again, opening price is really what tells you what's going on, right? Although we're in a bearish trend, we're actually opening at R4, which means we're into breakout territory. So if Facebook sells off a little bit and then comes up and makes a new 5-minute high, I can long R4 right here for the breakout. And you can see just a great breakout occurs. And notice again, similar to the SPY chart I showed you earlier, notice how we found value just above the prior session's R4. These ranges hold from day to day pretty well and can be used to reference across multiple days. But eventually you can see we got up here, we set value, and then we ebbed and flowed a little bit, and then we finally accepted it, right? Value set, value accepted. So this is what the cheat sheet looks like overall. And I'm going to have a copy of this, like I said, in the room drive. I'll try and upload a fresh copy of it tomorrow. So basically, whenever you're looking at a stock and you're evaluating it for a trade using the pivot system, you can use this. So if you're looking at bullish bias here, right, you pivot ranges, you can say, okay, I'm starting with a bullish bias, and then you can make a decision. Am I opening above the pivots or am I opening within the pivots, right? And then you can make a decision. Do I have a narrow range for an outside day or do I have a wide range for an inside day, right? And then you have your contingents, which I'm going to update these a little bit more with some additional criteria. So this part of the list will grow as we go, but you will see some different conditions here for what you can do at different areas. And like I said, I will detail that out more. Notice here on our no bias day, we have that inside tighter range. And we've got the verbiage that goes around that, right? We're going to want to stay out of the chop. We're going to want to play the breakouts of the fourth levels, right? Lots of potential for a big move and all of those kind of things. So it's really, really important to use this flow. If you can kind of go through and use this, what you'll find is that you're going to look for an area to be established, and then you're going to go. Playing the open auction, that's why we need to see the price open. Where's it going to open, and what is it going to do once it does? When we open, do we immediately run to the top side? If it's really, really fast, then this might not actually be a strong move. It actually might be a squeeze before a very weak move, right? That's why we really don't trade pre-market with this system. I haven't traded the pre-market for a few weeks now that I've really dove deep into this system, and I wanted to really prove it out. And I'll add my hit rate's gone up by like 10 or 15%. Pre-market was always kind of a coin flip for me. Giving it up was actually a great decision. And actually staying out of the first 5 and waiting for value to be established has helped me out even a little bit more then. Today, I actually went 5 for 5 green trades. All of them were pivot-based trades like this, and I'll actually show you a couple of them at the end of the sesh. So I'm going to show you some examples of setups here that I've pulled out of recent charts, right? Not all of these are going to be live trades. I actually notate which ones are live trades versus which ones I've just documented. This one's a documented. So the first thing I want to note here is that value is established near R4 of the prior session, right? So you can see right up here on SQ, we've got value established right under R4. And that's really important because we were at the top of this range, and notice it was a wide range, right? So again, perfect example of not trying to trade long at R4 because you're in an inside day, right? So there's no reason trying to get outside when it's an inside day. So in this instance, you could have tried trading it short, or most likely, since value is being established high, you would have just stayed out of it, right? So the next day, notice what we had. We had a higher range, sure, but again, we're opening really high in the range. Not only that, we're opening near 2 sessions ago's R4, and we're opening extended from value. We opened at R3, not R4, right? So if this was a outside day and we were opening up near R4, we might actually look for a breakout in this scenario. But since we're opening on an inside day and we're opening near the top, I'm going to let it sell off and come back up to R3. And if it stalls and rejects, I'm going to go short. I could use high of day here with safety and still get a beautiful drop down to S3, full traverse there, right? And then this one actually went a little weak and sold off even better throughout the, would have sold off even better throughout the day, right? So, and I put the criteria for that under here. All right, AMD. So AMD is a really nice example of an S3 to R3 traverse, and it's an inside day move. So you notice how tight sometimes, and this is what takes a little bit of the finesse, right? Some of this stuff's a little artistic, it's subjective. You have to learn how to interpret it, and that takes a little practice. But one thing you can see here is AMD had a very, very tight range right here. And notice what happened. We opened below S3 and did a S4 breakdown and ran down for the entire day. So as you can see here, this is exactly what we're looking for. We had an outside day. We're opening low in the pivots, and we actually broke down for an S4 breakdown from the pivots, right? This is exactly what we're kind of looking for. But now notice in the pre-market on the next day, we end up with this much wider range, which makes us think inside day. Yet we're already broken down from S4. So having an inside day and already looking to be below S4, I'm thinking to myself, I don't think I would sell this off anymore. So at the open, it sells and it comes right back into S3. And this ends up being a perfect long for a squeeze and a traverse right back up through R3, right? And what is it doing? Kyle Flips just threw it out there in the chat room. Smooth operator as always, Kyle. Notice we had value set here. What happened? We just returned back to value. Nothing more, nothing less, right? We moved away. We gapped away from value in the pre-market. At pre-market, we bought right back up to it, right? Neo, this is an R3 to S3 to R3 traverse on an outside day. So in this instance, we actually catch the traverse, and it actually ends up being a breakout. Sometimes when you're playing an inside day or an outside day, you manage to grab it a little bit better in the area. Now, this trade would be coming into the gray area, but I'm taking it into the gray area after it rejected S3, right? So I waited for the extremes, but you can't take this trade just, at any time. You got to wait for confirmation. I wanted a new 5-minute high, right? And I want to see this thing go. So you can see we have a wider range on NEO the prior day on this day, the 24th, incredibly tight range, right? So we sell down into the gray area, bounce S3, long at the new 5-minute high. Beautiful outside day, breaks out, real big move, right? Now, once we get up here, we hit big orders up at the top, and that's where we establish value. I couldn't show both value ranges on this one, but just for clarification, prior value was down at S3. So if I zoom this NEO chart out, if I could roll it back out and add a couple more days to value, this yellow line drops from here right down to S3. So when it pulled down, I'm already kind of looking there because I already know that's where value is. And if we start to sell off, I expect it to come into value. That's what I want to see what happens. When we get to value, what happens? Are we going to get down there and just accept it and start to chop? Or are we going to get down to it and immediately reject it, right? And that's what happened on NEO. We sold off into value and then immediately rejected it to the top side, right? We immediately got shoved out of that value area. Volume came in and the stock popped. Right? So it's just a perfect example of how you can play in and out of value like that. And it's important, just throwing this out there, to consider value on all time frames, right? Value on a 1-minute chart with about 20 minutes worth of time selected is very, very precise. And it's right. It's correct. In that time frame, micro time frame, that value is 100% right. Right? But as you add more data, you start to go from micro to macro, right? The more data, the more participants, the better the assertion of value. And then what we're playing here is micro value to macro value. We're going to go away, we're going to establish a little value zone higher, and then we're going to return back to the larger value zone. And then we'll probably go under the larger value, find lower value below, come back up to the larger value. Eventually, catalyst, something comes in, maybe short interest is too high, so Wall Street Bets comes in and takes care of your stock for you. I don't know. Eventually, the catalyst comes in there, and then it's up and down until it's done, right? And then it just goes. When that happens, that's when you get breakouts like this on NEO, where you're finally breaking out from R4. This is where you've hit that extreme now. If it goes past here, it should keep going because that's a signal that we're going in broader search of value. A value in this instance that we perceived to be much higher. Right, value in the instance of using VPOC is subjective. Right? As you zoom in and out, you add and subtract data. So VPOC will dynamically change. But again, none of it's wrong. Value at every single level as you zoom in and out is valid and should be accounted for, right? Depending on the strategy you're trading and how you're playing. If you're playing intraday and scalping, you may only need to know what the next closest 1 or 2 value ranges are so you know where you're going to be playing to. If you're playing an intraday swing like I do, probably helps to know where the larger, broader value is on a daily or maybe even a weekly chart. If you're swing trading or long-term investment strategizing, you may be looking to play an even broader value than that. You may be looking at a 1-year, a 5-year, a 10-year chart, trying to see. Remember, because these longer-term participants have been involved in the market for years, the value they've established over the course of time will still hold true even today. These can be positions like my family has held since like the 40s, right? I mean, it can be anything in over any span of time can be valid, because if those participants are still involved in the market, then their reactions are still going to be valid. So here's a little look at the SPY. I really I like this one for a nice little outside day view. Notice SPY, we closed lower, and this is a nice example of the S4 breakdown, right? We see here we have the wider range. This time we're opening with a much tighter range and to the downside, so we've got bearish feel, and we've got a outside day setting up. And in this instance, our price is actually opening pretty low. So we have a bearish feel, a tight range, and a low opening price. It's only a matter of time until we get this breakdown. But a perfect example of how trying to play an outside day while you're on the inside will get you chopped up. Notice if you were trying to short SPY anywhere during the opening, half the day, right? The SPY is just chopping up and down, up and down, up and down in this area, nonstop. And it isn't until it finally loses. And look at this retest of S4. I mean, come on. Look how accurate, look how precise that retest is of S4. Which, by the way, I assert that the SPY loves Camarilla points. And I'll let this stand for itself. But notice as we break down, we buy back up into S4, and as soon as we lose that, pow, right into the close. Big drop. Took almost all day for the SPY to finally drop out of that range. But again, perfect point of where you can get chopped out trying to play inside during an outside day. Right? If it's an outside day, if the weather's beautiful, you got to go outside and play. So this one I want to illustrate an R4 extreme reversal. Now, I call this one versatile because this works on inside and outside days. Right? If you ever find yourself opening under R4, if the price climaxes there or stalls, rejection's a big deal, and you're probably going to come back down to value. Now, notice where value is on the larger time frame, right? All the way down here. So we've already had a down day, and we've been in a bearish trend. We're opening, and our cams are very wide, right? So I'm still expecting an inside day, and we're opening really close to the top of the range. So putting those things together, you've got an inside day paired with a bearish trend, and you're already opening near the top of where I would expect a pullback to go to, right? As soon as we open at R4 and immediately reject, right? We drop straight down. We bounce back towards R4. No bueno. Can't make it back. Can't even test it this time. We roll over, throw massive indecision, make some new lows, get short, right? Short at R3. S3 traverse is the target. R3 to S3. Beautiful move off of the extreme. Now, if you were playing a Rising Devil, you could have played this extreme reversal. Just a lot sketchier because we haven't established value yet. But notice, once we rejected this breakout, we returned all the way back and set greater value below. And then once again, we move to S4 and then return right back to value, right? We move away, and the next day we open right back at value. All right, here is an S4 extreme reversal. Notice here we had a wide range, and then we had a slightly narrower range, and this one actually opens a little bit up. So we have a bullish feel to this one because we're actually opening slightly above yesterday. And in this instance, S3 lines up with this nice little area here where we accumulated yesterday. So I already know that value's up here because it's showing on the larger chart, and I've seen that we've had large defenses of the price have occurred at this lower level multiple times, right? So once the price opens, it sells off into S4 and immediately bounces and comes back out of that range long at the new 5-minute high, S3 to R3 traverse for the R4 break that fails, and then I go all out at the loss of the moving average, right? Nice little pop up and down, but again, you can see this is why we want to play the extremes. Playing it from here, my RVR is tight. Anywhere else, if I had tried to trade AMD anywhere else in here, other than down here at the extremes or up here at the extremes, very, very difficult to manage the risk on the trade or to get a good move. This is why it's just super, super important to move down. In this instance, it's the loss of the new 5-minute low, which is also the same as this prior day's low, right? So the thing is once we go down in here, there is a certain amount of risk you don't need to take. If this comes up, rejects S3 and moves back down, I don't need to be in it for the loss of S4, right? This thing's probably going to come back down and break down, stop me out. Might as well just hold it tight, give it the new 5-minute low for an out, and otherwise manage the risk on the way up. All right, so I'm going to show you some real trades. And these are trades that I actually took in some instances today, in other instances maybe yesterday. But you know me, I really like to have, thank you, Chris, I really like to have a couple of live trades in for everybody, just so you can know that it works and you know that it works in real time. So MNRA trade, I don't have the, let's see, did I put the 5-minute chart on the next one? No, I didn't. So mRNA trade opened up and we were in a slightly higher range. And we were opening in the top of the cam, so I was looking for an R4 breakout. mRNA had good catalyst with some new stuff coming in. So I was looking for a break here. You can see here, once we came back through R4, I went long R4. I gave myself the loss of value and capped myself a real nice 3R, 4R trade before I took the rest off at 2R at the loss of the major average. Not too bad. DKNG, I put this one on there. It's a little bit of a heartbreaker Romo trade. It wasn't happy letting me have this one, but I want to show. It's a perfect example of playing an inside day with an R3 to S3 traverse, so I had to include it still, even though it broke my heart a little bit. You can see here on the prior day, DKNG had a beautiful breakout. Notice the tight, the narrow pivot range. We tested R4 breakout all day, every day. This thing went on a beautiful run, and it established value here. And you can say it stayed there all day. So we had a really nice establishment of value. So this is going to hold pretty good, right? So as you can see here, we had an out or an inside day set up this time with the wide points. And notice we're opening pretty high on the price. We're definitely in the top of the range. So rather than play this long, I let it squeeze to R3, and then I played the rejection. And unfortunately, I got stopped out at break even after capping 3R, 4R, and then I stopped out my remaining because I was going to hold one more. But I was hoping to really get this thing to move all the way back down to S3. We did get a move back to value, which is what I would expect. And I was hoping that drop below value would have gone just a little bit further. But my all out, if I had managed to survive this, would have been at the loss of the 20 EMA around S1 when we curled back up. But all in all, still a really solid move. All right. This is actually a SPY trade that I took today. So I thought it would be fun to share. Again, pivot relationships really help out here. We have a wide range on the 21st. And then on the next day, notice we have a much tighter range. And what happens? We get an R4 breakout. Right, SPY goes on a really nice breakout and sets value right here at just shy of 419.50. As we break out and we move up towards the next day, we still have a fairly wide range, so I'm expecting an inside day. And notice we're opening under R3. As soon as we open, unfortunately, it doesn't give me the squeeze to R3, so I wasn't able to take this short because I felt too much in the gray area. So I didn't take it short, and notice the first thing we did, right back to value on the prior day, right? Pow, no problem. And then we move down, we go under S3, and we pull back up, and I go long at the new 5-minute high at S3, and I get a really nice move on the return to value. Pow, pow, pow. And then I stopped out at break even. What are you going to do on my remaining little, that was like 15%. I was going to try and trail up to R3. All right. So this concludes the Camarilla Pivot series. To close, I want to remind you of some final thoughts. There is no big secret cabal controlling the market as far as I can ascertain. Just millions of overreacting participants. Some large, some small, but none with the ability to control the market. Even the market maker, to a degree, has no control over things. All they can do is move the price to where we are willing to transact it. I feel like there are times when we start to feel like someone is out to get us, that the deck is stacked against us, and that we are at some major disadvantage. The reality couldn't be further from the truth. As a retail trader, we are in a unique position. Our share sizing is so insignificant that no one is worried about us. This allows us to detach ourselves from worrying about the larger picture items. All we need is to see where the larger participants are making choices. Once that happens, you can ride the wake of their massive vessel, knowing that all you need to do is wait and get off when they tell you. Avoiding the chop isn't just a strategy, it's a mentality. If you can wait, if you can let the price action show you where key decisions are being made, then you can transcend patterns. Let go of conventional decision making and embrace systems with conviction. I hope everyone has a great evening, and humbly, thank you.